Most financial collapses don't begin with bad decisions. They don't start with someone being reckless, irresponsible, or careless with money. They begin with emergencies. And that's what makes them so dangerous because, unfortunately, financial trouble rarely announces itself. It doesn't show up with the alarm or some countdown, but it usually arrives quite quietly. I'm talking about a medical bill that wasn't expected, a car repair that couldn't wait, or a few missed paychecks during a job transition. On their own, these events don't seem extreme. They're normal parts of life. But for most people, they're enough to trigger real financial trouble. And again, not because the emergency was massive, but because there was nothing underneath to absorb the impact. Today, we're going to talk about why so many people are one emergency away from financial trouble, and why this has far less to do with income or discipline than most people seem to think. Let's start by pointing out, what does it mean to be financially stable? For this video at least, being financially stable doesn't mean paying your bills on time. It doesn't mean your bank account hit zero on the last day of the month instead of the third. And it doesn't mean your life looks fine from the outside. Financial stability means something much more specific. It means being able to absorb shocks without falling behind. It means when something unexpected happens, your financial life bends but do not break. You might feel some stress, of course. You might be forced to slow down your current progress. But the key is that you don't spiral. That's the main difference. A lot of people confuse survival with stability. If the bills are paid, things feel stable. But survival is actually quite fragile. It often depends on everything going right. Stability, on the other hand, is different. Stability assumes things will go wrong sometimes, and it plans for that reality. And this is where the gap starts to show. Many people are surviving financially, but they're not stable. Their financial system works only as long as nothing interrupts it. The moment life deviates from the script, even slightly, the whole structure starts to wobble. That's not because people failed, but it's because the definition of stability was never truly met in the first place. One of the biggest reasons a single emergency can cause financial trouble is low liquidity, not low income. A lot of people earn enough on paper, meaning their income looks decent and sometimes even quite good. But the money is already spoken for before it even arrives. Housing, transportation, insurance, debt payments, food, utilities, subscriptions, childcare. By the time the paycheck hits the account, most of it already has a destination. That means there's very little cash sitting around, ready to respond to something unexpected. This isn't about poor planning, but it's about structure. When money is tightly allocated, there's no flexibility. So when an emergency shows up, there's no loose cash to absorb it. The response isn't a calm problem solving, it's actually more of a scrambling. Credit cards, payment plans, borrowing, delaying other bills. And once those reactions start, the emergency doesn't stay isolated. It spreads. Low liquidity turns small disruptions into big problems, even for people who technically earn enough to be doing fine. Another reason one emergency is enough to cause trouble is the way fixed expenses quietly consume flexibility. Most people's largest expenses are fixed or semi-fixed. Rent or mortgage payments, car loans, insurance premiums, debt minimums. These expenses don't adjust when life changes. They don't care if your income drops temporarily or if an unexpected cost appears. They show up exactly the same every month. And when fixed expenses take up most of your income, flexibility disappears. That's the danger. When flexibility is gone, emergencies don't have anywhere to land. You can't reduce housing costs overnight. You can't pause insurance. You can't skip debt payments without consequences. So when an emergency arrives, it forces impossible trade-offs. Which bill gets delayed? Which expense gets skipped? Which future problem you're willing to create to solve today's problem? Fixed expenses turn emergencies into pressure cookers. And the more fixed your financial life is, the smaller the emergency needs to be to cause real damage. Many people are one emergency away from trouble because their financial life depends entirely on continuous income. Money has to keep coming in on schedule without interruption. There's no slack in the system, no pause button, no backup. That works beautifully when income is stable. But life doesn't guarantee stability. Jobs change, hours get cut, health issues appear, companies restructure, entire industries shift. When income stops or even slows, the clock starts ticking immediately. Bills don't wait. Expenses don't care why income changed. And without buffers, every day without income increases pressure. This dependence creates fragility. Even short interruptions can cause long-term consequences. Late fees, missed payments, credit damage. stress that affects performance and decision-making. The emergency doesn't have to be permanent. It just has to interrupt income long enough to expose how dependent everything was on things never changing. Another major reason one emergency is enough is the lack of true emergency buffers. Many people think they have a buffer, but they don't. A credit card isn't a buffer. A line of credit isn't a buffer. Borrowing is not protection, it's delayed impact. A real emergency buffer is cash that exists specifically to absorb shocks. And for a lot of people, that cash simply isn't there, or it's too small to matter. Without buffers, every emergency becomes urgent. There's no time to think, no room to compare options, no ability to wait for a better solution. Decisions get made under pressure, and pressure leads to expensive choices. High interest, bad timing, long-term consequences. Emergency buffers don't make emergencies disappear. They change how those emergencies behave. Without them, problems accelerate. With them, problems slow down. And that difference matters more than most people realize. There's also a psychological reason so many people are one emergency away from trouble, and it's surprisingly human. It's optimism bias. Most people assume things will keep working because they always have. The job will still be there, the car will keep running, health will hold up. Nothing dramatic has gone wrong yet, so the future feels safe by default. This optimism isn't foolish. It's normal. It's how humans cope with uncertainty. But financially, it creates blind spots. Emergency planning gets postponed. Buffers feel unnecessary. Risks feel distant. And because emergencies are rare in any single moment, they're easy to dismiss until they're not. Optimism bias doesn't cause emergencies. It causes unpreparedness. And when reality finally interrupts expectations, the emotional shock often makes the financial shock worse. People freeze, panic, or rush decisions. That psychological layer is what turns manageable problems into overwhelming ones. Here's the uncomfortable truth. Emergencies don't usually cause financial trouble. They reveal it. They expose how little margin existed, how dependent everything was on everything going right, and how fragile the financial structure really was. That doesn't mean people failed. It means the system was never built to absorb stress. Emergencies are stress tests. And for most people, the test doesn't need to be extreme to show cracks. A single event is enough. Financial resilience isn't about avoiding emergencies. It's about building a system that can handle them. Stability isn't about perfection. It's about margin. And margin is what turns emergencies into setbacks instead of collapses. If this video helped you see financial trouble in a new way, click on one of the videos on your screen right now. They go deeper into how financial stability actually works and how to build resilience without extreme strategies or unrealistic advice. I'll see you in the next one.